Welcome back, everyone, to the deep dive. This time, we're going deep on something I know a lot of you are really curious about.
Chart patterns.
You got it. Seems like everyone's trying to crack the code on these things.
It's true. There's a ton of information out there, tons of opinions.
Yeah, and it's hard to know what to believe. Like, are these chart patterns really the secret sauce, or are they just, kind of like reading tea leaves?
Well, let me show you how it works. First thing to keep in mind, chart patterns, they aren't predicting the future,
Right. Okay.
but they can give us some clues about where prices might be headed. They're more like, think of them as footprints in the sand. They tell us where the crowd of traders has been.
Oh, interesting. So it's more about, like, understanding the behavior of the market.
Exactly. It's all about understanding that psychology, the market psychology, and using historical trends to our advantage, and that's what we call technical analysis.
Okay, so it's not just like, I don't know, throwing darts at a board. There's actually some, like, real science behind it.
There's a method to the madness.
Okay, that's good to know.
Yeah.
But, like, how do we know which patterns actually work? Because I've seen so many different ones. It's, like, a little overwhelming.
It can be. Professionals, here's what they look for. Patterns that have played out consistently over time. They want those patterns backed by data, solid research, and believe it or not, some patterns are way more reliable than others.
Okay, so there are some, like, all-star patterns, right? Spilled beans. Which ones are at the top of the list?
Let's start with, the heavy hitters. You've got the inverse head and shoulders.
Okay.
That one boasts a pretty impressive, 89% success rate.
Oh,
Yeah. An average price change of 45%.
that's pretty good.
Then you got the double bottom coming in strong at 88% and the triple bottom at 87%.
Okay, I'm writing all this down. Keep going.
Yeah. And we've also got, the descending triangle.
Yep.
And then you have the rectangle top, rectangle bottom. We've got the pull flag, the ascending triangle, the
Yep.
rising wedge.
Hold on. This is a lot of information. Are you telling me I need to, like, memorize all of these to actually, like, make this work?
No, not at all.
Okay, good.
It's more important to understand the principles behind a few key patterns than to try to memorize the whole encyclopedia of them.
Okay, that makes me feel a little bit better. But how do we even know what to look for? Like, how do you spot these things in the wild?
Think of it like, learning a new language. You start with the basics, the most common words and phrases. So let's take, for example, the head and shoulders pattern.
Good.
It's a classic. And it literally looks like its name. 3 peaks, 2 shoulders, and a head in the middle.
Wait, so you're saying if I see a chart that literally looks like a head and shoulders, that means something's going to happen?
It could, yeah. It usually signals a potential downtrend, especially if the price breaks below what we call the neckline.
The neckline.
Yeah, it's a support line that connects the two troughs.
So it's a warning sign like, hey, watch out, this stock might be losing steam.
Exactly. It suggests that sellers are, starting to take control.
Okay.
Now, on the flip side, you have patterns like the cup and handle, which is a bullish signal.
The cup and handle, that's the one that looks like a cup with a handle.
Yeah, you got it. It often suggests a potential upswing, after a period of consolidation.
Okay. So, like, it takes a little break and then...
And then it might make a move.
Yeah. All right, this is starting to make sense.
Yeah.
But are these things always reliable? Like, could they be misleading?
That's a great question. And that's where a lot of people get tripped up. No trading strategy is foolproof. And chart patterns are just tools, right? They can give us an edge, but they're not guarantees.
So what's the secret? Like, how do they use these patterns differently? What are they doing that the rest of us aren't?
Well, the key difference is that professionals, they don't rely on these chart patterns alone.
Oh, okay.
Yeah.
So there's more to it than just, like, I don't know, seeing the shape and going all in.
Yeah. You got it. They use them with other indicators, fundamental analysis, and most importantly, risk management.
Risk management, that's a big one.
Yeah.
Okay, so it's like they're using these patterns as, like, pieces of a puzzle. They're looking at the bigger picture.
You got it. It's all about connecting those dots. The pros, they treat chart patterns like pieces of a puzzle. They're considering the company's financials, the overall market sentiment, and then they look for patterns that confirm their hunches.
Oh, so it's not about, like, blindly following. It's more about using them as part of a larger strategy.
Exactly. And they understand timing is everything. They don't just jump in because they see a pattern forming. They wait for that confirmation.
Wait, so you're saying there's more to it than just, like, spotting the shape? Like, what kind of confirmation are we talking about here?
Okay, so let's say you see a bull flag pattern, right?
Okay.
On a stock that's trending upward, that's a good sign.
Right.
But a pro, they wouldn't just buy right away.
Okay. So they're waiting for something.
Yeah. They would wait for the price to break above the upper trend line of the flag, and they'd want to see a surge in volume.
Oh, so it's like they're waiting for a signal that the buyers are really like piling in and pushing that price up.
Exactly. That breakout strong volume, that's their green light.
So pros are patient. They know that not every trade's going to be a winner, but by waiting for those like those high probability setups,
Mm-hmm.
they kind of tilt the odds in their favor.
Yeah.
Okay, so this is where it gets like really interesting for me.
Mm-hmm.
What does a high probability setup actually look like? Like, can you give us like a real world example?
Sure, sure. Imagine a stock that's been like in a clear downtrend, and it starts forming a double bottom pattern.
Okay, I see that shape on charts a lot. Like, what makes that a high probability setup?
So that first bottom, right, it might scare off some, weaker hands, the people who are just selling out of fear.
Right, right.
But that second bottom, it can attract buyers, people who are like, hey, this is a bargain. And then if the price breaks above the neckline of that W, with increasing volume,
Yeah.
it suggests that buyers have taken control.
So it's like the crowd is kind of like testing the waters.
Yeah.
And then when they feel confident, they're like, okay, let's jump in.
Exactly. Now, here's where risk management comes in. Even with a high probability setup, things can go wrong. So they set a stop loss order.
Wait, a stop loss? That's where, like, you automatically sell if the price drops below a certain point.
You got it. It's like an insurance policy on the trade. You're protecting your capital.
Right. Rule number one. But doesn't that stop loss, like, sometimes take you out of a trade that, like, might have turned around?
Yeah, it might, but that's the discipline, right, of risk management. Pros, they'd rather take a small loss and move on to the next opportunity than hold on and risk a much bigger loss.
Right, yeah. You don't want to get caught holding the bag. So it's about playing the long game. Okay, I'm starting to understand how all these pieces fit together. It's not just about, like, finding the patterns. It's about, like, understanding how to use them in the context of a strategy.
And here's the thing, the market's always changing.
Right.
What worked yesterday, might not work tomorrow. So pros, they're constantly learning, they're adapting, they're refining their approach.
So they're not just, like, stuck in their ways. They're, like, always looking for an edge.
Exactly. They backtest new patterns, try different indicators, and they adjust their strategies based on those market conditions.
Wait, backtesting, you mean like testing their strategies on historical data?
That's right, yeah. They want to see how those patterns have played out in the past to get an idea of how they might perform in the future.
It's like they're, like, constantly running experiments.
You could say that. They're always trying to optimize their approach.
This is so cool. It's like we're starting to, like, see these patterns through the eyes of a pro. But let's be real. Not everyone has the time or, like, the expertise to, like, analyze charts all day long.
That's true. That's true. But, there are tools and resources that can help. I've got charting platforms, software programs. They can actually, identify patterns.
Oh, wow.
And even alert you when they're forming.
So it's not all about, like, eyeballing these charts manually. Like, technology can actually lend a hand.
Exactly. But remember, those tools are just the, tools. You still need to understand the underlying principles of technical analysis.
So it's about finding that balance.
Yeah.
Like, using the technology, but also, like, developing your own skills.
You got it. The more you practice, the better you'll become at spotting these patterns and seeing how they actually play out in the real world.
This has been so eye-opening. It's like we were starting to see, like, the matrix behind these chart patterns.
That's the goal. It's all about learning, adapting, refining that approach.
So we've talked about, how the pros approach these chart patterns and how they use them as part of, like, a bigger strategy. But I'm still kind of fuzzy on how it all comes together in an actual trade. Like, can we like walk through an example?
Yeah, absolutely. Let's take the cup and handle pattern. It's a classic, it's a bullish continuation pattern.
Yeah.
And it's one that, even legendary traders like William J. O'Neill have used successfully.
Yeah, the cup and handle, we talked about that one earlier, right? The one that looks like, well, a cup with a handle.
Yeah.
But how would a pro actually trade that?
All right, so here's what they look for. First, you want to see a stock that's, already in a solid uptrend. That sets the stage for the pattern to form.
So we're not just looking for this pattern in, like, any stock.
Yeah.
It has to be one that's already kind of showing strength.
Exactly. Then you're looking for the cup itself to form, that rounded bottom, where the price, corrects or consolidates for a bit.
So it's like the stock's taking a breather before its next, like, move up.
Yeah, that's a great way to think about it. And now here's the interesting part. As that cup forms, watch for the volume to decrease.
Okay.
That tells us that selling pressure is weakening.
Wait, so you're saying lower volume is actually like a good sign in this case?
It can be, yeah. It means fewer people are selling, which could signal a shift in momentum. Once the cup is formed, you usually see a smaller pullback, forming the handle. It's shorter, shallower than the cup.
Got it. And the handle, that's like another consolidation period.
Yes, but notice that during the handle, the volume, it typically stays low. And that's a clue that the big players, the institutions, they're holding their positions, waiting for the right moment to push that price higher.
So that's how we know, like the big money's still interested.
Yeah,
But how do we know when it's actually time to like jump in?
the breakout. The breakout is key. When the price breaks above the upper trend line of the handle with a surge in volume, that's your signal.
So it's not enough for the price to just like break out. We need that volume to confirm the move.
You got it. That volume spike tells us buyers are piling in, driving that price higher. But even with all these signs, pros, they never enter a trade without a stop loss order.
Right, the stop loss to like limit the potential losses. But this is where I get confused. Where exactly would we put that stop loss for this trade?
Well, a common approach is to place it just below the low of the handle. That way, if the breakout fails and the price reverses, you're out, quickly, minimal damage.
So we're basically saying if this doesn't work, I'm cutting my losses and moving on.
That's the mindset.
That's the pro mindset.
They're disciplined about protecting their capital, which allows them to, stay in the game for the long haul.
This whole deep dive has been incredible. I feel like I've learned so much about chart patterns and how to like approach them like a pro.
Well, I'm glad to hear that. Remember, the key is to stay curious, keep learning and never stop honing those skills.
Well said. And to our listeners, thanks for joining us on this journey into the world of chart patterns. We hope you found it insightful and maybe even a little bit empowering.
Absolutely. Remember, chart patterns, they're just one tool in your trading arsenal, but they can be a powerful one when used correctly.
So keep practicing, stay disciplined, and always, always manage your risk. And most importantly, have fun exploring the markets. Who knows, maybe you'll discover your own like secret patterns that lead to those profitable trades. Until next time, happy charting.